Do cash calls actually work? When a legend like Warren Buffett sits with over 300 billion cash and refuses to invest, it's very natural for us to think that being in cash is going to give us some opportunities of a lifetime which will make us tons of money. But do investors always make the most out of cash calls? I keep asking myself this question. Many times investors who sit on cash end up not investing at all. The majority of the investors, this is their experience, because when the market falls, investors revisit their targets when they want to invest. For example, when the market is high, you create a cash call and you sit with cash. When you sit with cash, you tell yourself that when the market comes to this particular level, I will invest this money. But the mind does not work consistently. When the market actually comes down to the level where you originally wanted to invest, you promptly revise your target downwards and say that I won't invest now, I will invest when it comes further down. When investors make a couple of revisions like these, the market tends to go down even beyond their revision, but swiftly reverses and goes up again before they can invest. So the purpose of being in cash can often get defeated if investors are trying to time it too finely and to get the maximum out of their cash call. So investors who sit on cash want to get it accurately right in timing when they put the money into market. Now, this leads to investors not investing when it's a reasonably good time to invest. Investors sit out right through the correction, and when the stock price reverses direction and started going up, they start thinking that they will get one more correction. But stock prices which fall a lot also tend to rebound reasonably quickly. Especially if you are wanting a good stock to fall a lot, then that rebound is always going to be faster than you can catch. So your reflex is not going to be helpful. So the very purpose of being in cash can often be defeated for such investors. So by trying to be accurately right, investors miss out completely on the investment opportunity or start chasing the same investment on the way up only to invest it after a lot of time has lapsed and a lot of value has been surrendered to the market. So essentially, while being fearful when others are greedy, an investor still has to be greedy when others are fearful. If you are just going to keep cash and be fearful when others are greedy and not invest when there is blood on the street, then you fail to be greedy when others are fearful. I suspect a lot of investors are heading in this direction. Personally, I think it is better to be approximately right than accurately wrong. Investors who try to perfectly time the market and when they are going to deploy all the cash they have end up being wrong while seeking the accurate or the perfect moment. Whereas investors who buy all the way down at different levels and then buy all the way up at different levels tend to be approximate in their assessment of when to invest, but they end up being approximately right in their investing. This is something that I have seen across market cycles happen to others, and in one or two cycles even happen to me. So you take the macro view of the market and the sentiment of the market too seriously when the market falls. You don't think that you should take a contrarian view early enough. You end up not taking the contrarian view on time, and the time when you should have made contrarian bets tends to lapse with you sitting on a lot of cash and not making anything out of the opportunity that presents itself. This market could well be a market where a lot of investors could sit out and not participate at all despite having cash. But when you look back later, you will hit yourself on the head for having tried to become a perfectionist beyond what is required in your investing and for allowing that needless perfectionism affect your investing in the way that it can. I think that investors like Buffett are rare. Everybody cannot be Buffett. So, as an investor, you need to understand who you are and what style of investing will help you invest as the markets go down. Stagger your investments well enough to ensure that timing risk or buying too much too soon doesn't affect you in your portfolio decision making, and buy all the way down and again a little bit on the way up before you stop buying. That way you would have bought good businesses and great businesses at valuations that can give you good to great returns. More importantly, you would not completely miss out on the very opportunity to invest in equities. This is a very, very important time to invest. This is not a time to be a very snooty spectator or a perfectionist who is trying to get what the market cannot give him. It's important to take what the market throws at you, especially when the valuations are in your favor and the businesses are exactly what you like. This is not the time to miss out on such opportunities. If you miss out on an opportunity like this, you will definitely live to regret it for a very long time. A lot of investors who had money did not invest during the early stage of the COVID crash. Yes, they invested later and made some money, but if they had invested in the early stage of the COVID crash, they would have really killed it in their portfolio. So, when you see the markets going down, don't try to seek perfection. Don't try to be more perfect than necessary in your investing. Make use of every little opportunity to invest in individual stocks or in mutual funds. Make sure that when the markets correct and reverse, you are investing steadily where you have conviction, and after the market has again reversed and gone up, you should be in a place where you feel happy that you achieved a lot and accomplished what you always wanted to accomplish in your equity investing. Thank you for watching this video.